In the next couple of videos, I'm going to talk you through how to set up and use your Market Replay environment. Now, any course that requires this is going to have a tab on the right hand side, how to activate, set up and use the Market Replay environment. There's then a few steps to go through to access the Market Replay data and then to create your order flow tool from Jigsaw so that you can then trade on that data. So first up, how to get the data. Click on this link here. What this will do is it will take you through to Tradeovate sign up page. All you need to do here is to sign up to create a Market Replay account. Agree with the terms and conditions and make sure you remember the password that you used here. This will be very important in terms of inputting that into Jigsaw later on. So once you click the link, it will take you to this page here. Enter your details, enter a username, which again is going to be very important for later on, and then a password. Agree to terms and conditions and sign up. You will then get an email sent to you. From here, what you want to be doing is opening that email. This will allow you to confirm your email. Confirm your email and then your account is set up, and that is all that you need to do. Make sure, as I say, that you have noted down the username, your password, because that's going to be crucial to input into Jigsaw when you set that up to get you started on there. So next video, we're going to show you how to set up your Jigsaw account, how to download Jigsaw and how to get your Jigsaw replay working. Okay guys, so next up it's time to set up your Jigsaw account. Now in order to do this, click the terms and conditions box and then click create account. Only click this once though. If you click it more than once, what it will do is it will try and set up multiple accounts, and it will believe that you're trying to set up a duplicate account. So click it once. Once you've clicked on it, you'll be given your username, which is your email and password, and then a password. Copy this password and head to the members area, so through the link given. From here, enter those details and you will then be able to access your Jigsaw account. Now from this point here, what you can do, and the two things that you really need from here are your licenses and then download. So first up, what we need to be doing is downloading Daytrader. So Jigsaw Daytrader downloads, click in here and download the most recent version. Follow this through as would be normal with any download of a new piece of software. So follow the software through. If you do have any issues, let me just click this open for you. If you have any issues, it could well be to do with your firewall not allowing this to open. So for example, you may get a message like this. Click on more info and run anyway. It is a trusted publisher, and so you'll be able to then use that app from there. So once downloaded, you will then get an icon like this on your screen. Click on the icon and this will bring you up your main toolbar. So here's your main toolbar. What you will see is it will be grayed out. The next thing you then need to do is click into licenses. So on the website you will have a lifetime license and a live trading license. On your Jigsaw main toolbar, file, licensing, and you will be given 2 areas to enter these licenses. So your lifetime license first, you don't need to put in the bit that says open, so it is merely a case of copy, paste, activate, and then your live trading license again, copy, paste, activate. Once these are done, you have then got yourself access to Jigsaw. This then gives you all of the different tools that you will need in Jigsaw. Now, the main thing that you then need to do is activate your replay software. So in order to do that, you need to click in Connections Manager, and that will bring you up a new window like this. Follow the drop down at the bottom, so you're looking to create a new connection to Tradeovate, and once you get that new connection to Tradeovate, this is where you then add in your details. Now the connection, it can be anything you want to name it, so name it something that is recognizable by you, something that is going to be obvious to you. So in this case, for myself, you then want your new username. This is the username that you gave for Tradeovate. So, and then a password, obviously the same one from Tradeovate. Your server, you want to click through as a demo and make sure that you tick the box Market Replay. This is the crucial thing that you need to have ticked. So that will then set up your new connection. Once you've got that, select your connection, click connect, and it will then connect you to the replay software. That's all you need to do to get yourself connected. The next video, what I will do is show you how to create your ladders and how to then start up your replay and get yourself trading any of these previous examples.
Okay, now before opening your ladders, there are a couple of key pieces of information that you may well need. So first up, back to the connection manager. Once you've selected your connection and clicked connect, it will load up your connected. Now one other crucial thing that you may well need to do is download instruments. Now if you click on download instruments, it brings you up this little box. What this does, particularly if you click include expired contracts, when you go back to dates some time ago, you'll need to have downloaded these instruments. So make sure you select the right exchanges, these being CBOT, CME, COMEX, Eurex. These will be the main exchanges that you're going to need. Once you've selected them, click download. It will then go through a process of downloading these symbols if it hasn't already downloaded them, and will flag that up at the bottom. Here we go, it's just downloading a few symbols for us. So this is then taking us back and downloaded any of the expired contracts that you may well need along the way. The other key piece of information as well is any of the times that are listed in any of the drills within any course. The time is based on UK time. So if you're in a different country, you will have to adjust your time accordingly. So adjust your time to make it the UK time. So if it says 10 o'clock, that's 10 o'clock UK. So you'll then need to put in the corresponding time to the UK time, whichever it is, based on whereabouts you are. So these are things that you'll need to do initially, but it can be an element of troubleshooting if you are finding that a symbol won't download or won't show. Check that you've downloaded instruments and check that you've got the right time. Otherwise, all should work okay. We'll now move on to the next video, which will show you how to open up your ladders, how to start your replay, and how to actually trade some past events that you will see on various different courses.
So now that you've connected to the replay on Jigsaw, it's just now a case of setting your ladders up so that you can trade any of the replay exercises given within courses. So in order to do this, what you need to do is you need to click on the hammer and gavel. This will then bring you up a symbol search. Click it once, you'll get your symbol search. You don't need to double click this. Make sure that you've got the connection selected that you had named, so that's why it's important to name it something you're going to remember. You then need to start typing your symbol. You will be given any codes that are necessary or any codes that you will need on any of the exercises. So as you start to type a code in, it brings up a drop down. You can then select the code that you wish to trade. Anything back to the beginning of 2017 is available. So in this situation, we're going for an oil contract CLX19. You click OK, and that will then bring you up an oil contract or a ladder that looks a lot like this. What it would also do at the same time is bring you up the controller for your market replay software, or for your market replay. In here you can change the dates to any date you wish, the time, and again you'll be given this in any of the exercises. What we do recommend though is to take away a lot of these columns, which give you a huge amount of information without necessarily helping you out. So what we try and do is then simplify this down, and a lot of the examples that you'll see in any ladders that you'll see from other traders will be simplified down into just a bids, asks and volume column. So to do this, click on the spanner and you need to untick in parameters, untick all of these columns apart from the order column and the volume profile column. Volume profile shows you how much is traded at each price. This is your bids, and you can move these around by left clicking at the top, holding it down, and you can drag these from side to side. Final thing you need to do, click on volume profile and show current trades. This is really important because that shows you what has then traded, or what the last quantity traded was in this little white box here. Now in terms of size and positioning, click on the dollar symbol and that brings you up this tab where you can select the size that you wish to trade. So if you want a 3 lot, click on the 3. Whatever's in this box will be the next quantity that you click. So if you click now for 3, or if you click now, you will click 3. If you've clicked on 5, your next click will then be 5. Something else that we would heavily recommend is select limit on here as opposed to auto or stop. Limit means that when you enter an order, you will either get to enter as a bid and it will become a resting order, or alternatively, if you click above the bids, so what would be termed as at market, you will then enter immediately. So this will give you a position straight away. It will buy the best price. This is particularly important when you're trading some of these exercises where you will need to get in quickly. If you have it on stop and you click higher up, it will just enter you a stop, which doesn't then actually get you into a position until that point trades. So to enter a position, you can click at market, or you can click in the bids or in the offers. To cancel any order, right click and the order disappears. So nice and simple, left click enters an order, right click cancels your order. That's all that you're generally going to need. Once you've got a ladder up, once you've made a couple of ladders, you may well need to do this a couple of times, but they should then start populating, and when you open new ladders, they will open in a standard format as opposed to opening and needing them all changing around. It's a small task if you do have to change them around, but it will then give you the ladders all set up for you. Any of the other buttons aren't really necessary. You have a market button which will hit market, although this is done just as easily by clicking at market with the limit order that you have. The number that you have here is the size that you're about to click next, so it gives you a sense of the position that you've actually already got. So if you're trying to add on to a position, or you're trying to use any tactics around building positions, this then shows you the size of the position that you've then managed to enter. So you've now got 10 lots, for example, on this trade. Again, to exit the trade, you can put in an offer that will allow you to exit there. Alternatively, if you want to exit at market, you can then sell 5 and sell 5 once more, and that will get you out of the trade. So that's all you need in terms of new ladders. If you need another ladder, you can open it up here. Again, all of the symbols that you need and times that you need will be set out on any of the exercises that you will see within any of the courses. So the main areas that you need: connection manager to make sure that you've got yourself connected to the replay. The hammer and gavel then gives you that symbol search where you can then start to open a new ladder. Remember, reduce the number of columns down, and that will give you something very similar to what you will see on any of the debriefs.
Hello guys, welcome to the practical application element of the central bank trading course. What the aim of this part is to familiarise you with 4 different central banks, and then also we're going to use different trading drills to show you different ways to trade these central banks based on certain different trading scenarios. So you're going to have the opportunity to replay certain trades, be able to see how they traded and also how you reacted to the information. So first up, you have an assessment of the information. I'm not going to tell you what should happen. All you'll get is the information, so you have a decision to make there, and then you can actually trade it based on that decision. So double learning there. First up, your interpretation of the information. Second up, how you actually trade it. So to start with, we're going to start with the Bank of England. We're then going to move on to the ECB, the Bank of Canada and the US Federal Reserve. So let's crack on with the Bank of England. Familiarise yourselves with this bank.
Directional move opportunities, scalp opportunities, absolutely, they were there. But
okay, so a couple of key things that are worth noting about the Bank of England before we move on. It is the 8th oldest bank in the world. As we discussed earlier on in the course, there was the previous or precursor to a central bank, but the Bank of England most definitely seen as the beginnings of modern central banking. Now, the next stage of central banking was the independence element. So Bank of England was nationalised in 1946. Remember, it had a charter prior to that to create loans for the government and be the sole issuer of currencies. After that, it was then made independent in 1998. The theory behind the independence is the fact that it should not have any kind of governmental influence over it. So this was done via the Banking Act in 1998. So the Bank of England is fully independent. Finally, and the most important thing, and you'll pick this up with every central bank that we look at, their mandate. This is what governs their monetary policy. This is the bit that tells you what pieces of economic data you want to be focusing on. Now, the Bank of England's mandate is price stability. This is quite a vague and all-encompassing term. However, this, because it's the government that gives the bank its mandate, has been defined by the government, and it's defined as inflation at 2%, and this target is symmetrical, which means that it is just as bad to be above 2% as it is to be below. Therefore, anytime we have inflation in the UK below 2%, theoretically the Bank of England should be expanding monetary policy to create that additional inflation to get us back to 2%. Conversely, above 2%, and monetary policy should become more contractionary, drawing inflation back down towards the 2% target. Incidentally, if inflation does rise above 3%, there is an open letter that has to be written to the Chancellor by the Bank of England explaining the reasons for this, which can give a little bit of insight into how they feel that these are going to change, or how they feel that inflation is going to revert back to 2% in future.
When it hits 95 and starts to bounce, we're not into the press conference yet.
Okay, let's go and have a look at the members. Now, the Bank of England's Monetary Policy Committee, the MPC, is made up of 9 members. Now, each of these members has an individual vote and the majority rules. Therefore, you don't have a situation whereby a consensus view is come about and the governor makes the final decision. It is purely down to the vote on who votes for what monetary policy going forward, therefore making it reasonably even and reasonably fair between all. Now, in terms of who these members are, you have 5 members who are central bank employees, including the governor, and then you have 4 members appointed by the Chancellor, so that's the finance minister for the UK. The idea here being is you dilute the power of the central bank a little bit, or in terms of dilute the influence perhaps that you could run the risk of having a very swayed central bank that has very similar views for every member. So the idea, a bit more variance here. There is a question mark around how much that maintains independence of the central bank, but that, for this course at least, is more of a moot point and more something of an academic element. Now, in terms of the members, what I've got here is a hawk-dove scale. You'll get this from many central banks, and the reason that you should be so focused on this is a hawk, by nature, is someone who is looking to have a much more contractionary monetary policy, generally is averse to higher inflation. So the idea is, if you are more hawkish in your policy outlook, then you are more likely to be looking for rate hikes and less stimulus. Conversely, a dove is going to be looking for less rate hikes and more stimulus in the economy. So you get this spectrum. Now, the importance of this is, if you hear a comment from a known hawk, McCafferty, Saunders for example, and their comment relates to raising interest rates, it's not such a surprise. If you hear the same comment, perhaps from Ramsden or Cunliffe, then that's where you've got a big surprise on your hands. So the significance of any comment from a central banker comes down to how hawkish or how dovish they actually are. So keeping this in your mind, I would recommend print this out, stick it to your desk so you know immediately, or can very quickly just glance down and there it is. You know exactly what the situation is. Now, in terms of the, again, importance, the governor is always the most important. So any comments from the governor, extremely important. Also, Chief Economist Haldane is also very important. Recent members, and this is the end of 2017, have been Ramsden and Tenreiro. I hope I've pronounced that correctly. They've been the most recent new members, and generally have fallen more onto the dovish side. Equally, we've not heard a great deal from them, and perhaps their comments will be taken with a little bit more of a pinch of salt, a little bit less influential on monetary policy, despite the fact that they do have an even vote. The expectation is generally that new members will often vote with the governor. So let's move on. We'll have a look at the meetings and how meetings progress, and how you also get the decision made.
Okay, so you've met the members. Now it's a case of, how do they actually make their decisions, and when do they release these decisions? The Bank of England runs 8 meetings a year, 4 of which are quarterly inflation reports. Now, the quarterly inflation report provides a little bit more colour, and the Bank of England will produce forecasts on where they view the economy, where they view inflation in particular going forward for the rest of the year, and this will help them come to any further decisions that they are going to make. So very useful in terms of gauging the Bank of England's sentiment going forward, but also offers an extra trade.
So you've got two different types of squeeze here.
You will get those forecasts, and so much like a figure, the expectation of those forecasts can change, and so there becomes a trade.
For example,
now,
trying to play the breakout
with the quarterly inflation report, you also get a Q&A session. This is with Mark Carney, where he will answer questions for around about 45 minutes to an hour. And so, again, that does offer potentially extra opportunities, particularly interpretation trade opportunities, where he may add a little bit more information that perhaps hasn't come out in the initial statement.
With quite tight stops, essentially not wanting to take too much risk.
These meetings are structured in a certain way. We have 3 meetings, and they're each attended by a member from the Treasury. Now, this member from the Treasury can't vote. Remember, the Bank of England is supposed to be entirely independent of government. And the idea is that the member of the Treasury is supposed to be able to update the Bank of England on Treasury's activities going forward, and it's also an opportunity for the member of the Treasury to go back and inform the Chancellor on what's going on as well. So they can't vote, but they are there in the meeting and will at least be part of the discussions. So how do we get to the meeting and the release of the info? First up, we get a meeting that is just to discuss recent economic data, discuss the economy. This is also the beginning of the Purdah. Purdah comes from, I believe, Islam. This is an Islamic word, which basically means a period of secrecy. From this point, the week running up until the meeting and up to midnight of the meeting, you will hear nothing from any Bank of England members, or you shouldn't at least. So do keep your eyes out. If you do see anything from a Bank of England member in that period, it could well be very important, but it should not relate to monetary policy. Next up, the Monday before the decision, you get a meeting whereby a debate around the appropriate policy is brought together. This where everyone can share their views and come up with a general kind of idea of what they feel that the decision should be. And finally, the day before the meeting, this is where it's up to the governor to put forward the decision that he feels should garner the most support. He puts forward this decision, then anyone wanting to vote for it can, anyone voting against has to explain their reasoning, and this will often come up in the statement or come up in the release of the decision. So that's how the meetings work. The decision then comes out on a Thursday at 12 p.m. And so that's where you do get all of the information, and that's where the opportunity to trade comes in.
For these type of trades, in your planning of any of this,
right? Let's go and have a look at how the Bank of England can actually implement its policy, what tools it uses. Now, first up, you've got the most standard measure, which is standard across all monetary policy, and that's the bank rate. Now, the way the Bank of England operates its interest rates is it only publishes one rate, this being the bank rate, and that is the amount of money that they will pay on reserves held at the Bank of England. Now, the idea behind this is that if you can receive a certain rate of interest by holding reserves at the Bank of England, you don't have an incentive to then lend money at a lower rate. You wouldn't lend money to someone potentially less creditworthy at a rate lower than you could just put your money at the Bank of England. So if you have any excess cash, you're not going to lend it any lower. So it sets a floor on interest rates. Likewise, to the upside, you're not going to want to borrow too much away from this either, because of the fact that you could draw on your reserves at the Bank of England. Now, in periods of lower liquidity, people may have less reserves, and so therefore will actually borrow at higher rates. And this is where the Bank of England's OMOs come in to provide extra liquidity to the market, and that way maintain interest rates around about that bank rate. So that's the main one published, and that's the first thing you're looking at whenever you get any Bank of England interest rate decision. Next up, the asset purchase facility. This is the Bank of England's extraordinary measures. Now, What the Bank of England has done, unlike some other central banks, has set a maximum that they will go to. So they basically buy bonds up to the maximum, which currently is 435 billion. This was increased post-Brexit from 375, and also took in 10 billion of corporate bonds as well. So as I say, this is the maximum they will go up to. So effectively, the Bank of England just increases its balance sheet by 435 billion, and that provides additional funding to the economy. Now, what the Bank of England was finding with this is that this additional funding that went to commercial banks ended up being absorbed and then put back into reserves at the Bank of England. So it wasn't actually following through into the economy. It wasn't creating any expansion. It wasn't creating any inflation within the economy. So what did the Bank of England do? They then set up the TFS, the Term Funding Scheme. This is a scheme worth £95 billion.
The alternative to that,
the idea of this scheme is that banks, building societies can borrow additional collateral on the basis that this is then lent out to customers. The idea here being that they can receive extra money, so that it is effectively extra QE.
That allows you into that trade.
However,
I'll try and talk that one through when we go and have a look at the
it has to be lent out, and so
in the coming slides.
The borrowing from the central bank, or the additional funding from the central bank, had to be lent out, and that was part of the scheme. The idea here is that it encouraged lending to the economy and encouraged the build-up of spending within the whole economy, rather than just the hoarding of cash as commercial banks to build up their own balance sheets.
A situation where the market has positioned
Finally, and this is more of an emergency measure, but something that is still within the toolkit and an important part, because it provides an element of safety to the economy, and that's the discount window facility. This is their highly liquid asset lending to banks who are in some kind of crisis. So the idea here being that if there is a tightening in liquidity conditions, if banks will not lend to each other, perhaps for fear of credit, or perhaps for a lack of money that people are willing to lend, which is a general tightening of credit, banks can then use their collateral, go to the Bank of England and access the discount window facility, and therefore get their additional supportive cash to avert any kind of liquidity issues and potentially a bank run. So there's your four tools. Bank rate, the most important, followed by their extraordinary measures, the asset purchase facility, term funding facility, or term funding scheme I should say, and then finally the discount window facility, which is more a safety net as opposed to an ongoing used facility.
That is a long way higher. The close indicated by the red asterisk.
Just to give you a little bit of context on the tools that the Bank of England use. Here we have a chart on the left of the bank rate and how it progressed from the crisis in 2007-8, and also the increase in the asset purchase facility, or the beginning of it, and then the further increase. Now, what you notice is interest rates don't change a great deal. If you look particularly on the left-hand side of the chart of the bank rate, very gradual movements, stepped movements in rates, generally by 1/4 percentage point on each time that rates move both up and down. And you see that it takes a reasonable period of time to actually get these movements. And what we then saw was beginning of 2008 or later on in 2008, that's when rates really started to drop. We dropped within about 6 months from 5% down to 0.5%, so precipitous drop. And this was the attempt at stimulating the economy.
So let's go and have a look at the expectation.
First activity to stimulate the economy, reduce lending costs to allow people to spend more money in the economy, allow people to service their debts at lower rates. What we then got from mid-2009 was the beginning of the asset purchase facility to grow. And you can see how this was also stepped up as things became more difficult, as inflation struggled, as the economy struggled to recover, the asset purchase facility was increased multiple times.
You get 7-2 vote for a hike.
And this then took us further up and up to the rates that we're currently at now, at 435 billion. So it's just a little bit of history, a little bit of context, just so you can understand if we do see any crisis in the future, just how quick some of these things can move. Also, what it shows you is the very slow progression in the building back up of rates. Bank of England dropped rates following Brexit, and then come the end of 2017, rates have risen back up to 0.5%. Question now is this the end of any kind of further stimulus and
giving you a target,
not calibration, but an increase back up in interest rates as inflation does start to improve, as the economy improves generally.
44 to 46, which is also a
Okay guys, so now on to the more interesting part. You understand the members of the Bank of England, you understand their meetings, you also understand the tools that they use. Now it's down to communication. How do you get this information, and also what does this information tell you as well? Where are those trade opportunities? So the first key piece of communication, the most important bit you get from the Bank of England, is their 12 o'clock announcement on the day of an interest rate decision. So this comes out at 12 o'clock. You get a very clear structure of how the news is released, and the Bank of England does, quite helpfully, release it basically in a priority order. So the most important bits of information come out first, and you can then tick each bit off as you go forward. So, going to the 12 o'clock, as I say, a specified order that the information is released in, and your first up is your policy information. This is where you've got a very binary trade. What you get here is information on whether the Bank of England has changed rates, changed QE in any way. Now, the binary element comes in the fact that you don't usually get a situation where the decision could be a hike, an unchanged, or a cut. So you're either going to have a binary trade whereby it's unchanged or hike, and a binary trade where it's unchanged or cut. Now, the key thing with this trade is that it's all about the expectations going into it. If the market is expecting a hike, then the surprise is not the hike. The surprise would be the unchanged. So you will only have one option trade there. It's either going to be do nothing if there is a hike, or there's going to be a trade on the no change in rates. So that's your first area, and that comes down first. Next up, you get the vote breakdown. So this is assuming that rates have come out along with expectations, then you're looking at the vote breakdown. This tells you basically you will always get what the majority voted for first, and so the majority will have voted for the decision that you've already seen. You then get the minority vote, so you will always get a split either from 9-0 down to 5-4 as a majority decision on whatever the decision was made. Now, the key thing here is always that breakdown. That's where you get a specified binary trade. As I say, you could have 5 options for this. Now, what you're looking for here is then not every one of those options is going to create a trade. One of them will be expected. One of them perhaps will be semi-expected. So it's the more outliers that give you that binary trade. So you perhaps, if there was an expectation of 7-2, then a 9-0 or a 5-4 would be the specified binary trade there. So that's crucial. The other bit that you get just after that is the breakdown of who it was that dissented. So that 2 that you see in this example, you'll get to find out who they were, and that can help you out. If, for example, you're going to get then a pullback and a progression. The 2 that were voting for a rate hike were 2 hawks, then that would be quite expected. They'd be the 2 people you'd expect to vote for a rate hike. However, if it was a hawk and a dove, this is then telling you that come the next meeting, there is someone who's quite hawkish that could join this and then make it 6-3 at the following meeting. So there's perhaps a slightly more hawkish leaning there. So it's not just that vote breakdown, that's the first thing the market will react to. Then the information you get after that does give you a little bit more sort of colour around that decision. Next up, your forward guidance.
To sell as the market rises.
This is where the Bank of England provides you an opportunity for an interpretation trade, assuming that there's no change in rates and no change in the vote breakdown or no change compared to the expectations. Then it's down to the interpretation of their forward guidance. Have they shifted forward guidance anyway? Are they implying that perhaps there is something going to happen at the next meeting? Bank of England goes about this in multiple ways, and we'll talk about that in a little bit more detail in a minute. In this example, what the Bank of England tries to do is actually guide the market on their perception of interest rates going forward. So basically what the Bank of England says is that it may need to raise rates to somewhat greater extent than implied by market forecasts.
It's going to go here, and they view it as a straight line move.
So what they're basically saying to the market is, you need to adjust your perception. You need to price in a rate hike, or at least a movement towards a rate hike going forward. And that's the way the Bank of England can use forward guidance. If there's a change in that forward guidance, again, that provides a trade, but it is more interpretation. You've got to understand what they're actually trying to get across. Are they trying to get across a more hawkish or more dovish stance? And finally, and this only comes every 4 meetings, so on those quarterlies, you get the inflation forecast. This is a varied outcome trade because of the fact that whilst you know you're going to get a forecast for 1 year, 2 year, and 3 years out on inflation, on GDP, on unemployment, what you don't know is the severity of that forecast, so how far from the expectation that is. And that's where you get that varied outcome. You perhaps then need a limit on how far it's got to be above an expectation, for example, before you're willing to implement a trade. Yeah, for example, in this example, inflation 2 years out had dropped. So previously it was 2.7%, drops to 2.56. Now, you may have decided to yourself that you're still not going to trade that unless you see more than a 0.5% decrease. So you'd have to see a drop to 2.2 for you to be willing to actually trade. So that's where that variance of outcome comes in. The scale of the difference from the forecast directly will impact how much the market moves on it. So that's where you've got to sort of understand your limits on how far you're going to go and trade that. Alright guys, we'll now go and have a look a little bit more detail at the forward guidance. The rates and the breakdown of votes is very clear. It's a very clear numerical example. But the forward guidance is where you get a little bit more nuance, and this is the area that you really need to start to understand with the Bank of England. So we'll move on to that and have a look at a little bit more detail there.
So both reversal type plays. We'll go and have a look.
Let's have a slightly more in-depth look at forward guidance from the Bank of England. You see the little caption in orange on the right. That's from the Bank of England's website, and actually explains their way of looking at forward guidance. Now, back in 2013 when it came in, it was a data-dependent forward guidance. What they used here was a reference to unemployment rate falling below 7%, which could then trigger a change in rates. So basically they said that interest rates would be unchanged until unemployment falls below 7%. This then evolved. Unemployment fell below 7%, it fell way below 7%, below 5%, into the 4% area. And Bank of England didn't change rates.
No directional play into this. The market has been sitting.
So what happened is the forward guidance evolved. It then changed to any change in rate would become gradual and limited. So therefore the Bank of England is saying that they could be willing to change, but it would be gradual, it would be limited. So try not to get the market feeling that there's too much pace in the change when it comes, as opposed to prior having a very data-dependent forward guidance, which is something most central banks have moved away from now. What this does is it creates an immediate hawkish reference as soon as unemployment rates fall below 7%. The expectation then is the Bank of England may well raise rates. So,
good technical setup.
How do we see Bank of England communication and forward guidance nowadays? Their specific forward guidance is always related to stimulus, and this is the reference to gradual and limited.
Down to where the majority of the volume is in the 130.
They also will give a guidance on the market's interpretation of rates.
Now,
whether the market sees rates as being gradual and limited, and will tell the market whether perhaps it has got ahead of itself or got behind the Bank of England. And that's where I used in that previous example the somewhat greater extent language. You will then get a view on inflation from the Bank of England. This usually revolves around a reference to the Bank of England's tolerance for further inflation, and also watch out for the word inflation being interchangeable with slack. So greater slack in the economy means that
on the break of the wedge, on the break of the inside day,
there's more space for movement, and therefore you don't get inflation. As slack reduces, it means that demand for certain things, that there's less supply of them, and there's a greater demand for certain things. Therefore, slack is reduced, which then has an impact of raising inflation. So reduced slack or tightening of slack is interchangeable with increasing of inflation.
That's potentially going to
the next up, in terms of their strength of guidance, and this is quite key, Bank of England will use generally one of three words. They will use either some, most, or all. And this is to give a sense of how the members viewed certain elements of their forward guidance. They don't give you a vote breakdown on members' willingness to use gradual or members' willingness to use limited. They will just give a consensus idea of this. So some, most, or all being the way that they show strength in their guidance. Now, if you do want to have a look back at previous statements, click on the link there. It's got a link to all previous Bank of England statements, so you can see how these forward guidance elements have evolved. We'll now go on and actually have a clear look at how it has evolved. Certainly through 2017, and how this then actually led on to an increase in rates.
Suggestion that you're going to get 3 hikes over the next 3 years. So we're expecting around.
Okay, here we have the evolution of Bank of England guidance throughout 2017. First up, beginning of the year, rates unchanged, 0.25%. What the Bank of England says is it has little closer to limits of tolerance for inflation overshoot, therefore saying that inflation can't rise too much further before they may have to consider a change to monetary policy. They do, however, maintain a reference that rates could respond in either direction. So they could still add stimulus if they don't see inflation growing and if there is another shock to the economy, i.e. Brexit.
Rather than 2.
They give a specific reference to when rates may well be hiked, and the first hike could be at the end of 2018. The market in recent days has priced in earlier moves. They're basically guiding the market away from the recent move, saying that the market has got a little bit too hawkish when they perhaps didn't need to be. And so this causes a move to unprice that slightly hawkish bias from the market.
In terms of picking out where
moving into March, they then start referencing inflation as only a touch weaker than expected. Price pressures are clearly evident. Again, keeping this idea that inflation is increasing, and now some are considering reducing stimulus after very little further increase in inflation. So that's their interpretation of inflation, and then linking it to stimulus. This would be their forward guidance in a sense. That some people, not most and not all, so this is the sort of lower bound of strength in guidance from the Bank of England. No reference to market pricing, rates stay 0.25%. Come May, rates do stay 0.25% again. The some lead relatively little, not relatively little further, just relatively little, and that's that tiny nuance in wording there that can have a big impact on growth for inflation to consider voting for tighter policy. So a slight strengthening of rhetoric there, despite the fact they've remained with some, is some now see little upside rather than little further upside. Rates to rise by somewhat greater extent than markets implied. It's basically saying the market from February, where the market was expecting rates to rise faster, has now gone the other way, and so now it needs to bring their expectations back up.
Looking at a chart, your first thought is,
come June, Bank of England saying that CPI could exceed 3% by August, and Bank of England's tolerance for that increase in CPI has been eroded. Again, continuing this talk that inflation is definitely increasing, and now all agree that a rate increase would be gradual and limited. So now they're very much stepping away from the idea of response in either direction. It is gradual and limited, and it will be a rate increase, and they're quite specific on that. No reference to market pricing.
Next
come August,
you're then looking for a breakout trade, and with a lot of
they're now talking about a peak in inflation in October,
get the opportunity to take the trade on.
And also saying that actually nothing's really changed since May. So it's slightly stepping back on the hawkish view of inflation, some tightening of monetary policy to return inflation to target. So some are still talking about tightening of policy.
There are some very key reference points.
And this again is where they talk about that somewhat greater extent when they reference the market pricing of interest rates. September, and this is where you get the bigger clue to the change in November. It's not the November forward guidance that's the impact, it's the September. Inflation likely to rise above 3% in October. So whereas they were talking about it peaking in October, they're now saying that it is going to rise above 3%. So peaking around to rising above.
So what you're starting to,
and in this example, or in this case in September, most judge the withdrawal of stimulus over the coming months is likely. Increases would still be gradual and limited. So they maintain the gradual and limited, but now it's most members are looking for the rate hike. So that swings that majority, and that's telling you there's a very good chance at the next meeting that there will be a rate hike.
Comes a few minutes after the
decision. All judge the policy could be faster, policy change could be faster than markets expect. So again, very strong guidance here that the market is wrong. It's not that some, it's that everyone agrees that the market is wrong on this, basically implying to an even greater degree that rates are highly likely to rise a month later. Come November, we get that rate hike. Spare capacity has eroded a little more rapidly. Slack is fairly limited. So they're not saying that slack is tight, they're saying slack is fairly limited. So there is still inflation, but there's still room that inflation could increase where that limited slack is eroded. All agree that future rate rises will be gradual and limited. So now stepping back from referencing any further rate rises and just saying that they'll be gradual and limited going forward, which has been their previous description of rates. So once they've done the rate hike, they then fall back to their previous stance on monetary policy. So that's the evolution of rates from the Bank of England, or the evolution of guidance, I should say, and their evolution of rates. And you'll see this with all central banks, so keep a track of that. I'm not necessarily going to go through the guidance or the evolution for every central bank, but keep your own track of this, how each little element for each central bank changes going forward, and that then gives you a good scope, a good idea of where exactly the bank sits and what exactly they're going to be looking for going forward.
Some very easy and very obvious trades to take here. We'll see on a ladder.
Now, finally, if we go and have a look at this all brought together, so this is how the Bank of England release comes out, and this is the structure you need to follow here. Rate, vote, guidance. It always comes out in that order, and as you can see here, I've used the example from September. They maintain the rate, majority vote 7-2. So 2 people dissenting, you then get the list of who they were. McCafferty and Saunders, both hawks, both were looking for a rate hike. And then this is where you get that reference to some judge withdrawal of stimulus over the coming months. All agree that pace would be gradual to a limited extent, and all judge that policy may need to be tightened
what typically
faster than
after the first spike is we get
market expects.
A bit of trade
so
that creates a
there you go.
Range.
Follow that format. Rate, vote, guidance.
And we find resistance.
If you get nothing changed on the rate, nothing changed on the vote, then you're straight into guidance, and then any forecasts, if you do get them, if it is a QIR from the Bank of England. So that's your format. And also remember, crucially, and this is very key, read from the bottom upwards, because the most important information scrolls down the page, and so you will miss it if you start reading from the top down. Well, you won't miss it, but you'll be the last person to know, so you'll be acting once everyone else has already done
you're
their
looking
business.
then for a break of 50s and a continuation higher. But what we start to see here, we're just over a minute after the event. Volumes have started to fade a little bit. We've started to slow down. Once again, another push up to 50. Do we see any continuation? No. So what we've now got is a range that we're waiting to see the break of. Now, from a technical point of view, those shorts could well now have been viewed as being squeezed out, and we're then going to get new shorts established on a break back below 19s and 10s. So that's going to be your idea. If you are sticking to this technical view that we have a position squeeze up based on the technical wedge break, that position squeeze up, then we're looking for more selling as we come back below 19s and 10s. Whilst above there though, whilst inside the inside days range, we've still got scope to the upside. And also based on the slightly more hawkish decision from the Bank of England, we've still got scope there. So there we go, down towards 20s. And we're starting now to actually just have a little bit of a tip through 19s, 20s. Find support again. You now need the support to act and start giving us a buyers, bringing the market back up through the 25s where the average price is, back up towards the 50s once more. But what you're now starting to see here, it's struggled at 25. We've had another attempt at selling here. This could be your first attempt at the breakout trade to the downside through the 19s. If we can get through 10s, then you should get the acceleration. So here's the first push down towards 12s, 13s, and we find some buying quickly. Now the important thing here, if you're going for the short, is that we don't break 19s. If we get back above 19s, then your reason for the short is no longer valid. And also the more important element is you're looking for it to move back through 10s. We're not seeing that. We're now starting to tick back up above 19, and so we can now start looking for a move, particularly if we get through 25s, all the way back up towards the 30s to 50s area. So the first attempt is not there. That first attempt lower has failed at 19s. We're now starting to tick back up through the range. And still a potential opportunity. Those who are long, they're still feeling they've got a little bit of comfort in this trade. They're still slightly safe on this, and we can still be looking for a further continuation up towards 50s and then potentially all the way up towards the new high. So we're back into that range and back consolidating once more. This is giving us a little clue. We're starting to establish a low that's important down at 12s, which also coincides with those previous lows where the main part of the breakout is likely to come from. So that's what we've managed to establish so far. Remember, these trades often can take a little bit of time before we get the next leg of the move, and so you get 45 minutes now before the next leg. The next video will show the final leg here's what you need to know going into the drill, the replay going forward. Right, previous meeting, break it down. We have got unchanged on rates, policy vote was 7-1 to keep rates unchanged. Language-wise, we didn't see a great deal from the Bank of England. Rates to rise somewhat greater extent than implied by market, and some need relatively little upside to raise rates further. In terms of expectations, we're expecting a 7-1, possible 6-2 vote. In terms of stimulus, unchanged completely. Possible language change, but this is likely to be limited. It's all likely to be a comment on inflation. Is it to do with the some or all members? Recent data, CPI has been very, very good. CPI is nearing the Bank of England's limit of 3%, and it's also the highest it's been in 4 years. GDP pretty much unchanged. Unemployment falling. It's down to the lowest levels on record, 4.5%. So good news generally for the Bank of England and the UK economy. In terms of movement, we're stuck in a range, as you can see from the charts above, 126.43 to 127.77. Also, one other thing to note going into this: Bank of England increased stimulus post the Brexit to aid the economy. Following a snap election, could a similar event unfold? In terms of statement changes, what you're looking out for is a potential to change the reference to some need relatively little upside on inflation to raise rates, change that to most or all for an on an increase in inflation. In terms of levels, looking to the upside, 127, 24, 41, 61, 77, the top of the recent range. You're then looking at 95 and 128.21. To the downside, 126.78, 64, the low of the recent range at 44 to 42, and then double O's. Remember, a 100 tick move is not uncommon in these situations. Right, trades then. This is what you've got to be thinking about here. Now remember, we're looking for a specified binary trade here, just to give you a little bit of a clue. In terms of action, they could hike rates. This would be buy pound, this would be a hit and hold trade. Very, very hawkish. We could see a change in votes. This could either be an 8-0 or a 5-3. Votes could also be 6-2 or 7-1 as well. And this is where the specified binary element comes in. Only 2 of these vote counts are likely to create too much movement. And so you have a dovish and a hawkish scenario, either way. And this is where you need to prioritise your trades. If we see no change in rates and votes in line with expectation, you then start looking at language, and that's where the most or all need relatively little upside on growth and inflation to consider voting for tighter policy. If it is shifted to most or all, then again that's going to be a buy at the pound, but it's not going to be such a strong buy as an actual shift in rates. So that's what you've got to be thinking about. What's the order that you're going to take these trades on, and also what's the scope of how much these trades could move.